Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex financial world. Today we are looking at Blackstone Private Real Estate Credit and Income Fund. And let's just say there's a new loan in town and it's a big one. Alright, so what are we really looking at here? Essentially, this is a bit like a company announcing they've secured a major new credit line to fuel their future deals. It's a Form 8K, which means it's reporting a significant event that investors need to know about right away. This report is dated September 12, 2025, and it tells us that on that very day, a special part of Blackstone Private Real Estate Credit and Income Fund, a wholly owned subsidiary, inked a deal for a master repurchase agreement. Think of this as a special kind of loan agreement specifically for buying and selling assets and then agreeing to buy them back later. This particular deal is with Canadian Imperial Bank of Commerce acting as the main bank for a group of other financial institutions who are the actual lenders. This agreement is pretty substantial. Initially, it's set up for up to $250 million, but it's got flexibility. The bank can decide to increase that limit all the way up to a massive $500 million. This money can be borrowed in either US dollars or Canadian dollars. So what's the plan for all this cash? The fund intends to use this new financing tool to help them buy or create new real estate assets, which is exactly what a real estate credit and income fund is supposed to do. Now let's talk about the cost of borrowing. The interest rate isn't fixed. It's tied to what are called benchmark interest rates like SOFR for US dollars and CORA for Canadian dollars, and then they add a special margin on top. This margin can change depending on the specific assets they're using as collateral for the loan. It's a bit like saying the interest rate is based on the general market plus a little extra depending on the quality of the deal. This loan agreement has an initial term of 2 years. During these 2 years, they can keep drawing money as needed. After this initial period, they might be able to extend it for another year and then potentially even longer, depending on how the loans are structured and when the underlying assets are expected to mature. This gives them a good runway to deploy the capital. It's not just the subsidiary that's on the hook. The parent company, Blackstone Private Real Estate Credit and Income Fund itself, has also signed a guarantee. This means if the subsidiary can't repay the loan, the parent company is on the line to cover it. This is pretty standard for these types of deals, showing the parent company's commitment. This is where things get really interesting from a financial health perspective. The agreement comes with some strict rules called covenants that the company has to follow. One crucial one for the parent company is a minimum net asset value requirement. They need to maintain a certain level of assets minus liabilities. This minimum is calculated dynamically. It starts with a base of $25 million and then increases based on new purchases of their own stock after a specific date in June 2025, but it decreases if they buy back their own stock. This ensures they maintain a solid equity base relative to their activities. It's a way for the lenders to make sure the company isn't over-leveraging itself and is always able to back its financial commitments. One other thing to note is that the company is ticking the box as an emerging growth company. This means they can use some relaxed accounting and reporting rules compared to larger, more established companies. They've also elected to use the extended transition period for adopting new accounting standards, which gives them more time to get ready for those changes. Overall, this filing shows Blackstone Private Real Estate Credit and Income Fund is actively seeking to expand its financing capabilities to support its investment strategy. The large credit line points to ambitious growth plans in the real estate lending space. The terms of the agreement, especially the interest rate structure and the covenants, will be important to watch as they execute this strategy. The minimum net asset value covenant particularly signals a commitment to maintaining financial discipline and lender confidence. This is a strategic move that could significantly boost their ability to acquire or originate more real estate debt investments. Now, looking at this filing, it signals a proactive approach to funding. They're securing a large pool of capital that gives them flexibility to seize opportunities in the real estate credit market. The dual currency aspect and the ability to scale the facility up to $500 million are clear indicators of their growth aspirations. However, the reliance on benchmark rates plus a variable margin means their financing costs could fluctuate, impacting profitability. The covenants, especially the one tying their equity levels to share purchases and buybacks, are designed to protect lenders, and as long as the fund can meet these, it shows responsible financial management. The key takeaway is they are gearing up for significant activity. opportunity, and this financing is the fuel for that engine. What's your take on this new financing deal? Does this aggressive move signal strong opportunities or new risks for Blackstone Private Real Estate Credit and Income Fund? Let us know in the comments below. If you found this breakdown helpful, hit that like button and subscribe for more straightforward financial analysis. Don't forget to join our growing community on Discord. The link is in the description. Thanks for watching. See you in the next Decode.